Welcome to this session from the Skilled MBA Case Study Series, where we explore the intersection of healthcare innovation and investment capital. Today's case, Thrive Early Detection and Catalio Capital Management, examines how Thrive, a pioneering cancer diagnostics company, and Catalio Capital, a healthcare investment firm, navigate their strategic partnership. How does Thrive secure the right financing for its groundbreaking cancer detection technology? How does Catalio Capital manage risk while maximizing returns in the evolving healthcare investment landscape? This session will analyze market forces, investment strategies, and regulatory challenges shaping this partnership. Let's begin. Thrive Earlier Detection is a biotechnology company dedicated to early cancer detection through advanced diagnostics. Catalio Capital Management is an investment firm specializing in funding healthcare innovations like Thrive's technology. The strategic partnership. Thrive needs capital to fund research, regulatory approvals, and market expansion. Catalio seeks high-return investments in cutting-edge medical technology. This case highlights how innovation and investment must align for mutual success. Several stakeholders influence the partnership's success. Thrive Management, focused on developing high-impact cancer diagnostics. Catalio Capital, balancing financial returns with healthcare advancements. Healthcare providers, key adopters of Thrive's technology. Patients, the ultimate beneficiaries, relying on early cancer detection for improved health outcomes. Each group plays a crucial role in shaping investment and market strategies. Both Thrive and Catalio face unique challenges in their partnership. Thrive's challenges: securing strategic financing for research and development, optimizing market positioning against competitors, navigating complex regulatory approval processes. Catalio's challenges: structuring investments to minimize risk while maximizing returns, supporting Thrive's innovation without overexposure, ensuring successful commercialization of healthcare ventures. Balancing these challenges requires careful financial planning and strategic execution. Several market forces impact Thrive and Catalio's investment decisions. Growing demand for early cancer detection, advances in medical research are driving increased adoption. Shifting investment climate. Funding patterns in healthcare technology are evolving, affecting capital access. Healthcare system. Evolution, regulatory and market dynamics influence the pace of new technology adoption. Understanding these trends helps both Thrive and Catalio position themselves for long-term success. Thrive and Catalio's partnership offers several strategic strengths. Innovative diagnostics. Thrive's cutting-edge technology improves early cancer detection. Strategic partnerships. Catalio provides funding and industry expertise to accelerate market entry. Strong market position. Thrive is well-positioned in the growing healthcare diagnostics sector. These strengths create a solid foundation for investment success. Despite their advantages, Thrive and Catalio face key weaknesses. Funding dependency. Thrive relies heavily on external investment for expansion. Regulatory uncertainty. Navigating FDA approvals and compliance is time-consuming. Resource allocation. Balancing R&D, market development, and operations is challenging. Managing these weaknesses is critical to long-term sustainability. Both companies must navigate significant opportunities and threats. Opportunities: expanding market demand, increased awareness of early cancer detection. Investment growth potential: Catalio can generate strong returns from Thrive's success. Technology innovation: advances in diagnostics enhance competitive advantage. Threats: Competitive market. Other biotech firms are developing similar technologies. Regulatory changes. Shifting government policies impact approval timelines. Market uncertainty. Economic fluctuations affect healthcare investments. Thrive and Catalio must mitigate risks while leveraging opportunities for growth. To make informed financing decisions, Thrive and Catalio apply several investment principles. Strategic alignment, ensuring financial investments support core innovation goals. Financial structuring, designing sustainable funding models for growth. Market navigation, understanding regulatory and competitive landscapes to optimize market entry. Applying these principles helps balance risk and return in healthcare investments. The first option is accelerating investment for faster product development and market entry. Advantages: rapid technology advancement, earlier market positioning against competitors, greater competitive advantage in healthcare innovation. Challenges: increased financial risk and exposure, more complex resource allocation decisions, higher performance expectations from investors. This strategy could expedite Thrive's growth, but requires careful capital management. Another approach is spreading investments across multiple healthcare ventures. Advantages: lower financial risk by diversifying capital, wider market exposure in healthcare innovation. Challenges: potential dilution of focus on Thrive, increased management complexity for Catalio. Diversification balances risk, but may slow Thrive's individual growth trajectory. A third approach is forming strategic alliances to enhance market positioning. Potential partnerships, healthcare institutions, increase credibility and adoption. Academic research labs, accelerate technology validation. Regulatory experts, streamline approval processes. Key benefits: expedited market entry and validation. Increased regulatory confidence. Stronger industry reputation. This approach could enhance Thrive's credibility and long-term stability. To determine the optimal investment strategy for Thrive Early Detection and Catalio Capital, we evaluate the available alternatives using 4 key criteria. Criteria: enhanced investment portfolio, diversification, collaborative partnerships, risk exposure high, greater financial commitment to Thrive, low, risk spread across multiple investments, medium, shared risk with partners, return potential high. If Thrive succeeds, returns are maximized. Medium, moderate gains across multiple ventures. Medium high, stronger market positioning but slower gains. Market penetration. High, Thrive gains first mover advantage. Medium, less focus on a single breakthrough. High, industry partnerships improve credibility and adoption. Strategic fit. Medium, requires careful capital allocation. High, aligns with Catalio's diverse investment strategy. High, supports long-term industry collaboration. Enhanced investment accelerates Thrive's growth, but involves higher financial risk. Portfolio diversification spreads risk but reduces focused impact on Thrive. Collaborative partnerships balance growth, risk sharing, and industry credibility, making it a strong strategic choice. By using this framework, Thrive and Catalio can make an informed decision that aligns financial returns with long-term healthcare impact. Based on this analysis, Thrive and Catalio should prioritize targeted investment, focus funding on high-potential diagnostic technologies, develop strategic partnerships, collaborate with healthcare leaders to expand credibility, adopt an adaptive investment strategy, adjust financial approaches based on market trends, engage proactively with regulators, work closely with government agencies to streamline approvals. By implementing these recommendations, Thrive can accelerate innovation while Catalio secures sustainable returns. Thank you for joining this session of the Skilled MBA Case Study Series. We now open the floor for questions and discussion.